Good morning, ladies and gentlemen. We are going to start our program in the next 5 minutes. So people who are outside at the foyer, may I request all of you to please come to the hall and take your seats. We are going to start in the next 5 minutes. So I would request all of you who are standing outside at the foyer, please come inside the hall and take your seats. You can carry your tea, coffee inside, but please be inside the hall. Thank you.
So good afternoon all. Our chief guest is now with us. May I request everybody to welcome our guest with a round of applause. I think everybody in this room is truly excited. This is one such rare event where you get a person like Mr. Deepak Parekh, who has the bird's eye view, not only on the Indian economy, but on the entire global economy happenings, how it will impact the markets. And I'm sure everybody is excited. Without taking any further time, I would request ICC President to kindly formally welcome. That's our local tradition. A welcome with, this is called Uttariyo from Bengal. May I now request President for his opening address.
Good afternoon, ladies and gentlemen. It's a real honor and pleasure to welcome Padma Bhushan Shri Deepak Parekh, Chairman, HDFC. Shri Parekh is a doyen of the financial and the corporate world and needs no introduction. A man who has seen and influenced the growth of India for over 5 decades. He has not only made HDFC the leader in private mortgage, but today HDFC is the second largest bank in India, having interests in insurance, capital markets, retail banking, with a 360 degrees financial services. His vision and advice has seen many transformations in government policies, and he sits on many boards across the globe. Sir, I have personally benefited from your insights on corporatization and transparency, especially in the real estate industry. I think we are all eager to hear him. So it is over to Shri Parekh. Sir, for your thoughts on Vision 2047.
Mr. Pradeep Surekha, President of the Indian Chamber of Commerce, members of the ICC, ladies and gentlemen, good afternoon. It's past 12. It's great to be back in Kolkata after quite a while. Kolkata used to be a city which I frequented very, very often for work, and over the years I've made many good friends in this city. The city has always been an amalgamation of old world charm and chaos. However, this time I was very surprised, pleasantly surprised, to see that the chaos has disappeared. And it's much more orderly, much more organized, and the credit must go to the people and the government to make Kolkata city manageable and less chaotic. Kolkata is characteristically unique, rich in culture, home to many intellectuals, and arguably hosts the country's largest football fan base. I must admit, visiting the city has always been good for my soul, though dangerous for my girth, with irresistible temptations of rasagullas, mishti doi and sandesh. But the nicest part of being here today is being able to meet all of you face to face. And no one now needs to say and be reminded to unmute yourself while speaking. So the year 2022 is almost over. The year began on a very high, with a sure shot of staging a strong recovery from COVID-19. It was a world that tackled the pandemic, bounced back with resilience, and seemed almost invincible. everyone agreed the worst was behind us. Cut to November 22, how wrong we all were in the early part of the year. Globally, the outlook has changed and has turned dangerously with recessionary clouds and several warning lights that are flashing red. I'm talking of globally. Across the globe, we can see economic crisis, political crisis, social crisis, debt crisis, currency crisis, trade crisis, cost of living crisis, and a climate change crisis, all playing out simultaneously. So we are in the midst of a global polycrisis. It is not just a situation of multiple and interconnected crises, but a situation where the whole is more dangerous than the sum of the parts. Last month, the IMF chief summed it up by warning the worst is yet to come. At best, let us hope, like the beginning of the year, we get these predictions wrong. Global growth, which was 6.1% last year, that is year 2021, is estimated to fall by nearly half to 3.2 in 2022. I'm talking of global growth. And is projected to drop further in 2023 to 2.7% in 2023. More than a third of the global economy will contract this year or next year. While the big three economies of United States, China, and the European Union are all projected to fall. In fact, US and other countries, developed countries, are having negative GDP growth rates for the last 3 quarters. Global inflation is estimated at 8.8% and is projected to settle down to a more acceptable level only in 2024. So these are inflation highs not seen before and not seen in the last 40 years in US and Europe. Thus, monetary policy reforms and monetary policy actions are likely to continue to follow the higher for longer mantra, higher interest rates for a longer period of time. This means prolonged high inflation along with aggressive interest rate hikes by most central banks as they endeavor to tighten money supply and restore price stability. Now, under normal circumstances, most central banks around the world tended to adopt a more calibrated approach to rate increases. Generally, 25 basis points was the norm at a time, increase at a time. Now they say central banks, 75 is the new norm. 75 is the new 25, which is shift in stance by major central banks to jumbo rate increases of 75 basis points each time. As we speak, the FOMC, the Federal Open Market Committee meeting, is underway, and markets expect that the US Fed to deliver its 4th consecutive 75 basis point increase this week in its key policy rate changes. So this would make it a 300 basis points increase in just 9 months. Remember, till recently, advanced economies had nearly $18 trillion, and all the advanced economies, particularly Europe and US and Japan, had $18 trillion of bonds yielding negative interest rates. Those were the days where money was easy and people could not invest and they could get negative returns. If you put money in a bank, you got negative return. So though these bonds have turned positive now, it is the cash savers, it is the individual, it's the cash savers who have drastically lost purchasing power over the last couple of years. And triggered by the Russian-Ukraine war, this is why higher food prices and higher energy prices is resulting in a cost of living crisis around Europe and the US. So what is the conundrum for central banks? Central banks, in determining the fine balance, they have to retain a fine balance between front loading of interest rates on one side and to curb inflation and growth. These are the two conundrums. So if they overdo the rate increases, it could stall economic growth. If they under increase interest rates, if they do not increase interest rates aggressively, then they fear inflation will go out of hand. So central banks around the world, including Reserve Bank, have a very tough role ahead to try to avoid a hard landing. So it is said, it's a case of damned if you do and damned if you don't. Economic data continues to be disparate, which makes policy making even more difficult and challenging. Even the much seasoned economist and US Treasury Secretary, Janet Yellen, had said that the Fed is going to need great skill and the Fed is going to need great luck to ensure a soft landing in the US. The US has inflation of 40-year high. They have not seen these inflations for the last 40 years and faces a looming recession. However, the labor market in US continues to be robust, so is consumer spending. But then again, US mortgage market is under strain, and housing accounts for a significant portion in the US economy. 15 and 30-year mortgages in the US have increased significantly over the last 9 months, and this has slowed down sales, dropped sales sharply. While US single biggest challenge is inflation, for the rest of the world, the challenge is twice what US is facing. First is tackling high inflation, and second is the dollar strength, the strength of the dollar. The dollar index, which measures the greenback against other currencies, against a basket of currencies, has risen 16% year to date. A strong dollar only benefits the American consumers who import a lot of things from China and other countries, while the dollar strength is causing severe imbalances in emerging markets. The yen up to date, from January, the yen has depreciated 23% against the dollar in the 10 months. The pound has depreciated 16%. The Chinese yuan has depreciated 15%. All this is in 10 months. And the Indian rupee has depreciated around 9%. Dollar continues to be a safe haven for investment and for savings. Besides rising interest rates, the dollar strength is also a culmination of a series of issues such as rising geopolitical risks across the world, UK's political saga, China's drastic slowdown due to its zero COVID policy, property market crash in China, and global investors shunning investments after the crackdown by regulators in the tech sector in China. So for China, the recently concluded, you all must have seen the recently concluded Communist Party Congress also unnerved investors around the world with this tonality and the tone of the press release which they made, which restrained capitalism and national security at top priority. No doubt the impact of dollar strength has been harsher for us in India and other emerging markets. The dollar strength has triggered risk of taper tantrums and sudden large outflows, which we have seen in India too, that have a destabilizing effect on the economy, on trade and finance also. Foreign exchange reserves of many countries have shrunk drastically, partly with central banks defending their own currencies and largely due to valuation changes. For instance, with India, our foreign exchange reserves, which peaked at $642 billion in October last year, a year ago, is now at $528 billion. Our import cover currently stands at 9 months compared to 15 months a year ago. 2013, at the time of the taper tantrum, India had an import cover of 6.5 months. But you will recall when the 1991, when we had the major economic reforms, the forex the foreign exchange reserves were just 15 days. So fortunately, the present situation in India does not warrant a warning alarm. We are quite adequately placed with our existing foreign exchange reserves. The IMF is giving advice to emerging countries that in this present situation, do not use your foreign exchange reserves, or do use your foreign exchange reserves more prudently to guard against possible future shocks, and intervene only to ensure macroeconomic stability. So I think RBI has been extremely prudent in its exchange rate management. We have never seen a free fall of our currency, and the present currency depreciation is not a reflection of a change in the fundamentals of our country, fundamentals of India. Now, looking at India, a critical question everyone is asking today is, how should countries balance goals of globalization versus goals of self-reliance? It is for each country to decide where their priorities are and where their comparative advantage is. The concerning bit is that relationships become fractured. There's so much of mistrust and polarization amongst countries. The biggest risks today aren't those of economic disruptions, but they are risks of despotic powers, strong, desperate powers, lack of cooperation, and growing weaponization of trade. Much of this has already played out. You have seen it's played out over the last 6 months with energy supplies, with natural resources, with semiconductors, amongst others. Right now, the world needs global cooperation more than ever before. For instance, some of the areas that need most global attention and cooperation are devising a common regulatory framework for crypto assets. Where is crypto assets going? What is the global view of crypto? No one knows. Every country, every central bank is looking at it. We need global cooperation to come out with a regulatory framework for crypto. Improving efficiencies of cross-border payments. Protection from cyber risks. Each country is going through this cyber risk problem, and forgery of checks and forgeries of your account, and jointly addressing climate risk related with finance. So the need for global cooperation cannot be overemphasized. Fortunately, and perhaps it is no surprise, that India's voice on the global stage is gaining heft. We have positioned our stance on the global arena. They say that India is a good country, India is a great country in a difficult neighborhood. India needs reliable partners, largely for defense equipment and crude. We have been able to stand the ground independently. You have seen our voting pattern in United Nations during the war, articulating a neutral stance when need be, and yet maintaining cordial relations with all our key trading partners. Russia is now the second largest crude supplier to India after Saudi Arabia. China and US are our largest trading partners. With China, the trade is one-sided. With China, the trade is one-sided. India importing much more from China than they export from us. While in US, there is a better balance between imports and exports. We have successfully managed to balance economic benefits for the country through diplomacy. While India is recognized globally as having a competitive advantage as a service-driven economy, we are known as the back office of the world. We are known for our services. But I do not buy that argument that we cannot be an efficient manufacturing hub. Why can't we be an efficient manufacturing hub? Also, apart from being the back office of the world. I think India is putting in place the right catalyst to increase manufacturing, like the production-linked incentives which the government of India has come out with for new sectors, for emerging sectors. We need to seize the opportunities from companies that are pursuing a China plus one strategy. Critics erroneously dismiss such endeavors, stating that India may never catch up with China, citing the example that last year China produced 230 million iPhones, while India made 3 million. So there's a huge gap. But I think this is changing. The point these critics are missing is that India is putting in place many high-end manufacturing capabilities. This is good for Indian economy because it helps create more jobs. And we will get there. I'm confident we will get there. India also knows that it's important for the country to be perceived as a reliable partner and a trusted destination to do business in, which some countries are not. No doubt, India has been conspicuous exception against global stalling growth. The globe is slowing down, we are not slowing down. This is why one keeps hearing that India is still a bright spot in the global economy. But we are not decoupled with the world. And we too will face some slowdown because of the global economics. But there is consensus that across the board, across economists from other countries also, across the multilateral institutions, that India will still remain amongst the fastest growing major economies in the world. Yes, GDP growth for 22 may be slightly lower than 7%, but there is no reason for disappointment. What is important to note is the inherent resilience that we have developed and which is now embedded in our economy. India's key advantage is the recognition of political stability. There's no question in anyone's mind about India's political stability at this point in time. This is why, and this is on which global optimism and future growth stand resolves around. Political stability and consistency of putting in place policy reforms and the relentless effort to keep improving things on the ground, ease of doing business, is why India is standing out. It is evident that the government of today is responding. It is evident that the government today is endeavoring to ensure that India's growth speeds up despite the slowing world. For instance, we were lauded around the world for our vaccine security, a difficult feat given the size of our country. Right at the beginning of the pandemic, we knew that there were limited fiscal space we had, and that the fiscal stimulus of the government had to be carefully designed only to go to the most vulnerable parts of our economy, society. While it was RBI that did the bulk of the heavy lifting to ensure that the system had sufficient liquidity, today the reason why India does not have any runaway inflation, why is our inflation not a runaway double-digit inflation? Because we followed a policy of restraint, which was exercised on limiting the fisc expansion, which means limited to print more currency during the pandemic. And this has really helped us, and this has really kept us in good stead. Another critical point India has is food security. With a record food grain production of over 316 million tons, India has rightly continued to exercise caution on its food policies. Recognizing vulnerabilities of the poor, government has extended its free food grain program of 5 kilos of rice or wheat, which commenced during the pandemic, and it goes on until December 2022. Despite putting pressures on the fisc, the government has continued this policy. Again, government has rightly applied brakes to curb exports, to deny exports of wheat and rice, to ensure that domestic prices do not rise too sharply. Today, global wheat prices are 50% higher. But we have still ensured that there are ban on wheat exports, because if we export wheat, we'll get more money, but the domestic prices can go sky high. And the recent increases in minimum support price provides incentives for farmers to increase their sowing. So we have a lot of going. India has a lot going now. Within the government, there's a constant drive to keep the reform momentum going, be it encouraging startups, be it increasing affordable housing, be it commencing and rollout of 5G services, raising India's shares of renewable energy, e-mobility, and Gati Shakti, which is the master plan for integrated planning and implementation of key infrastructure projects. The successful privatization of Air India, continued digitization initiatives for financial inclusion, and many more such initiatives. So I do not worry about India's macro, despite growing pressures on the current account deficit or the gloomy global environment. Many of India's high-frequency indicators are all doing extremely well. Take GST collection. Who expected that we'll get 1.5 lakh, government will get 1.5 lakh crores a month on GST collection? And this 1.5 is continuing for the last 5-6 months. E-way bills. Who expected that the e-way bills have shot up to a record of 84 million in the month of September, signaling a strong boost of economic activity during the festive season. UPI transactions have crossed 11 crore mark last month. Automobile sales have never seen such sharp growth. Just between Navratri and Diwali alone, an estimated 8 lakh passenger cars have been booked. Today, if you ask the car manufacturers, there's a waiting list, which we saw when we were young. There's a 6-month waiting list. The car dealers are saying even the demo cars have been sold. So the car sales have really gone through the roof. Demand for housing has continued to stay robust across the affordable as well as the high-end segment. Year-on-year bank credit has shot up to 18%, double digits, which is more than double than it was in March 22. So 6 months ago, it was in single digit, but bank credit has gone up to 18%. E-commerce in India is thriving, and these numbers speak for themselves. Online shopper base in 2021 was estimated 200 million in 2021. This is projected to more than double to 400 to 450 million this year. India is expected to overtake the US, which has the second largest e-commerce shopper base within a year. Over the past 3 years, we have seen a tripling of demat accounts, which now stands at over 100 million accounts. So a little bit on the stock market. Stock market gyrations will continue, but it is important to understand that apart from India, many emerging market funds have had exposures in China and Russia, amongst other countries. With Russia and China falling out of favor, many redemption pressures have been faced by global funds. India is a liquid market. India is an efficient market. And many investments in India, investors have made money. So when funds are needed to meet redemption pressures, they offloaded investments in India. That is why we've seen the massive outflow of foreign portfolio investors. Not because we are not doing well, but because they had other problems. They could not sell Russia, they could not sell China, and Brazil had a currency issue. So to repay their investors, they had to sell India, on which they had made profits. This is the reason for the high surge of foreign portfolio investors from the markets. It was more like a perverse, unintended consequence. Yet our stock performance has been relatively better. Why? Because retail investors, insurance companies, mutual funds have really saved the day. Year to date, in dollar terms, the US stock market is down 22%. This is the 9-10 months. China is down 33%, US is down 22%, while India is down 10%, despite massive sell-off. So with fewer options available, there is hope that emerging market funds will rebalance their portfolios, will rebalance the weightage in favor of India. I'm confident that this will happen. I also know many global funds are now talking about launching India-specific funds rather than emerging market funds. So despite heavy foreign selling, our equity markets have been able to counter this due to greater support in the form of domestic institutional investors, such as insurance companies, mutual funds, and retail investors. For the first 9 months of this calendar year, foreigners sold 1.5 lakh crore of equity, 1.5 lakh crore, while domestic institutional investors added 2.5 lakh crore because new IPOs and rights issues are also there. That's a big game changer and a big positive game changer for India and for the equity markets. Today, there's no dearth of investment opportunities in India. And this is what makes me feel so optimistic about our future. I keep telling investors that India has not even scratched the surface as far as financial penetration is concerned. Let me give you a few examples. Take consumer credit. People who borrow against cars, people who borrow against refrigerators, televisions, retail consumer credit. Consumer credit to GDP in India is at 37%, is amongst the lowest in any large economy. US, the ratio is 80%, China, it is 62%. India, it is 37%. Our business, mortgage to GDP is 11% in India. In China, it is 18. In US, it's 52. Insurance penetration is extremely low in India, even compared to Thailand and Malaysia. Both life and non-life, general insurance. Our mutual fund penetration is 17% of GDP. The global average is 80%. This global, including emerging countries, growing countries. So China's fund management industry size is $6 trillion. China's mutual fund industry, total assets under management by China is $6 trillion and has 60 crore retail investors, 60 crore retail investors. Comparison to India's fund management size is 488 billion. 488 billion compared to 6 trillion. And 60 crores investors, today we have 2.5 crore investors, retail customers. So the key question is, can we aspire to have 10 times more retail investors in the next few years? There are immense opportunities in the financial sector for growth. We are well on its march towards meeting the much aspired goal of a $5 trillion economy in the next 4 years or so. We need more savers. Today, there is a demand on liabilities because deposit growth has grown in single digit, 9%, while credit growth has grown at 18%. So long-term savers are needed for long-term investments. The second is the government needs to have mechanisms in place to legally protect those involved in disinvestment. Why is disinvestment transaction so slow? Because the bureaucrats, the people who run the PSUs are worried about vigilance inquiries, vigilance agencies, and therefore we see a slowdown. So government needs to have some mechanism to protect, legally protect those involved in disinvestment decisions. This will go a long way in speeding up the process of disinvestments. And more importantly, this will bring revenue, much needed revenue to the government. And they can deploy these in infrastructure and other more useful sectors. Third is need to push through significant power reforms, lowering the threshold for open access and opening up distribution and transmission. We have to open up distribution and transmission. This will pave the way for consumers to be able to choose their own utility providers and will help faster shift towards adoption of renewables. Key legislations are already in place for this. Electricity being on the concurrent list makes reforms more difficult. But this government has the political capital to push through these critical reforms. Far too long, the financial health of the State Electricity Board has been abysmal. Corporate India's balance sheets are very much stronger today than they were last year. than they were pre-pandemic. Capacity utilization of most companies have gone between 75 to 80%, which is conducive for fresh investments. One hopes that the lessons of over-leveraging are not forgotten when India Inc. gets back into its expansion mode. I always maintain that India grows when India builds. We need large amounts of long-term patient capital for our infrastructure projects. The country needs many more large engineering and construction companies, EPC companies. There are very handful of EPC companies. Who's going to build all what is required? Because unfortunately, India lost some of the large construction companies because they slipped into insolvency. I don't want to name them, but 4 or 5 large construction EPC companies have gone under, have faced financial difficulties. So we also need to help them. We also need to strengthen our legal framework to ensure that payment dues are honored in time and dispute settlements are settled in a speedier manner. Lastly, one hopes and prays that India will be powered by better skilled, better educated, more charged, dynamic workforce. The journey from India at 75 to India at 100 promises to be never like before. To my mind, what is most fascinating about India and its pace of change is, just to recollect, it took 60 long years to become $1 trillion economy after we got our independence. We got our independence in 1947. We became $1 trillion company in 2007. 60 years. It took another 7 years to become a $2 trillion economy. And we became a 2 trillion 7 years in 2014. And another 5 years to become a $3 trillion economy. So though we got slightly derailed due to the pandemic, we are now back on track to become the world's 3rd largest economy shortly. That's India for you and the world. With confidence and a commitment to implement and deliver, it is certainly advantage India. In the next 25 years, you will see the growth that we have not witnessed in the past. And I keep saying that in my 50 years of life, I've never been more optimistic about the potential and the future of India now than I've ever been. So thank you. It is a pleasure talking to you and sharing my thoughts and ideas with you. Thank you.
Thank you, sir. I think it has been, in all sense, a complete update on what's happening, what's emerging. And I think each and every word of yours gives us tremendous confidence that India is on the right track with the right kind of policies. So we will open the floor now. Could we open the floor now? And we can take some of the questions. Can we have the mics? Yeah. Mr. Beriwal, you could kick off with the first question.
So I had a couple of questions, but almost Mr. Parekh has covered all. One of the questions which is hovering around the economy is, people are talking about recession in Europe and US, which is already there. How do you see India negotiating with this problem in coming months or years?
As I mentioned, certainly there'll be some impact on India because of Europe and US recession and negative GDP growth rate. But we are a large domestic-based consumption story, and which is doing well. Which any sector you see the demand for, whether I'm not talking of cars, I'm talking of tractors, mortgages, housing, anything. So because India is not an export-oriented country and we are more internal and the consumption is really domestic consumption, unlike China and other countries which survives on exports. Exports are important, but we are not over-dependent on exports. And the domestic market is large. So there will be some impact because slowdown in the Western countries, but it's not going to impact. That's why I said, though the GDP growth rate was 7% last year, maybe a slightly lower GDP growth rate, which is triggered by domestic growth and domestic consumption.
Thank you so much.
Sir, you mentioned about our foreign reserves being 9 months. How do you look at that? Are we looking again at the crisis of 1991?
No, from 15 days, we have come to 9 months. So we are well covered. And you know, what is the biggest foreign exchange need India has? Crude oil. And we have really developed excellent relations with Saudi Arabia, United Arab Emirates, and Russia, who are our suppliers. And I have no doubt that oil prices, the high prices that are there now, have softened. It has come down from $130 to $95. And so the pricing also, and as soon as there's some indication that the war is coming to an end, the prices of crude will come down further. Because today Russian oil is not going to other European countries. And you know, the OPEC countries, they met and they said that we will shrink production. Now, if they shrink production, the prices go up. But they don't realize that the global demand for crude has come down because of recessionary trends. So I don't think that we have, with 9 months reserves, we are more than adequately covered. And we don't have an issue. Again, you must remember that two of the benefits which we have, which other countries don't have, is the foreign exchange earning of IT companies. Foreign exchange, all IT and back office companies, it's a massive revenue India is getting. Even small companies, even small foreign companies like IBM, Accenture, they all have over 3-4 lakhs of people working here. And 80% of the jobs they're doing is for overseas customers. So all that remittance comes in. So we have fair amount. Our exports, physical exports may not be, but the service exports are tremendous. The second advantage we have is that foreign remittances by NRIs. Foreign remittances, now forget the UAE and Middle East. Today, India gets more foreign remittances from United States. Indians who are there are remitting more money for their families here. So that is again an invisible receipt of foreign currency. So, you know, we have these two sources. They're not physical exports, but it's like export earnings. So I think we are pretty safe on that. I don't see that we'll ever get to that 1991 crisis where we had to sell our gold, pledge our gold outside and get money. I don't think we'll get to that. And the credit goes to the Reserve Bank of managing exchange rate well.
Bajoria.
From the fact that India, people abroad show concern that the per capita income in India of the people still remains low. And the G7, where we should be already a participating country, has cited reasons for a low per capita income not to include us, though we are the 5th largest economy today in the world. So how do you feel that the trickle-down effect can be accelerated so that the per capita income in India goes up exponentially? Though we've, as you correctly said, that there is a very small section of the population which is holding all the wealth. So, and this could further accelerate the GDP figures over the next 10 years.
No, you are absolutely right. Our per capita income today is what China was 20 years ago or 22 years ago. And we have a problem of that. But don't forget the way the per capita income is calculated. First of all, there are a lot of giveaways by the government. Take, for instance, they get cheaper food grains from ration shops. They're getting free, in the last 2 years, they're getting free rice and free wheat, rice or wheat, 5 kilos per month, per family. Despite that, our food grain stock at the warehouses are still full. There's no place for the new food grains to come. So you have to take those into account, take the unofficial earnings of family. It doesn't get reflected. People make so much money doing side work and alternate jobs and all, but they don't pay taxes. Per capita is done on taxes. Now there's so much of unearned income elsewhere. And the freebies that the government gives. Even take, for instance, in our business in mortgages, interest paid is allowed as a deduction. Interest paid to buy a house is allowed as a deduction. up to 2.5 lakhs of rupees. So these are incentives given by government to boost housing. No country in the world gives you benefit when you pay principal. India also, if you pay 1 lakh a month, a year, principal back, that amount can be deducted from your income. So it's a policy to get faster repayments and encouraging people to save and reduce and get that incentive. So these freebies or these incentives, whatever you call it, even in fertilizer, there's a subsidy. Even in electricity, there's a subsidy. So the calculation of GDP numbers, you cannot compare ours with others. But I agree with the point that our objective should be trying to double the per capita income to improve the quality of life for the lower strata of our society.
Thank you, sir. Thank you.
Good afternoon, sir. My name is Abhinav Khetri, and I'm also in the financial services industry. My name is Abhinav Khetri, and I'm also in the financial services industry. And I was following all the data points you were sharing about, of course, comparing India and China, and especially the mutual fund industry. And that's the specific industry I'm from. I'm a mutual fund distributor for the last 17 years. So my question to you is that you've seen the growth of our industry. You've seen the way the distribution side has also grown. But do you feel sometimes that the regulator in the case could make life slightly easier for the distributors? They've brought in a lot of regulations which have made it very, very difficult for us to actually grow exponentially. And there are separate set of rules which are there for the online players versus the offline players. There is a certain, like you also mentioned, the opening of demat accounts has grown exponentially. So India has gone from a country of savings to investments to speculation. Like you mentioned about crypto as well. So we want to pull people away from speculation back to investments. So what do you think the regulator could do more, or I'm sure you all also engaging with the regulator at various points, that the distribution industry, the distribution community can be more engaging with the investors and actually grow the base parallelly along with the online players. So any thoughts you could share on that, sir?
See, the regulators have to do their jobs. They cannot have free growth of financial companies around with no regulation. Now, regulations were more open, they were more liberal earlier, but after a few large institutions collapsed, a few large banks collapsed, a few NBFCs collapsed, a few housing finance collapsed, what would the regulator, what if you were a regulator would do? A regulator gets the maximum flack if companies collapse, because they're supposed to monitor, inspect, supervise these companies. And, their acts and their deeds, they have to account to the parliament. And they get maximum flack if a bank collapses. What have you been doing instead of regulating? So I don't blame the regulators for coming out with stronger regulations. Like take, for instance, NBFCs. There's a mushroom of NBFC. Everyone wants to start an NBFC. So they made registration more difficult. They made registration more difficult, and they've classified all NBFCs into 3 categories: upper layer, middle layer, lower layer. Upper layer is 50,000 crores and above. And they very clearly said for all upper level NBFCs, bank-like regulations will apply. Whether it is liquidity coverage ratio, whether it is SLR, CRR, they're coming out with new rules for upper layer. So basically, they're discouraging large NBFCs because few large NBFCs collapsed, and it was a big blow on the economic and the system, where people lost money, banks lost money, there are lots of frauds committed. So as a regulator, when things are going well, they can be liberal. But when they see these hiccups on the way, they have to come out with stronger regulations to regulate the growth. But the way the NBFC regulations have come about, it is better to remain a smaller NBFC, which has least controls, than become a large NBFC. Now, my point is that if you are 40,000 crore NBFC and you are going to get an upper layer, what do? Securitization. You would rather securitize, sell some of your loans to a bank or someone and remain under 50,000, so less regulations apply to you. But that is how Reserve Bank can control and contain these massive bankruptcies which have happened in the past. So they are doing their job. And I agree some regulations deter growth, slow down growth, slow down free enterprise to some extent. But in financial sector, you have to be more careful. You have to be more cautious.
Sir, Mr. Gupta?
Yeah.
Mr. Shuvankar Sen next.
Some quick comments, sir. One is on the employment situation. Second is on the rural sector slowing down. And of course, the standard areas, projections on the interest rate scenario and inflation. Okay.
So interest rates, as I mentioned, it's a tough balance Reserve Bank have to follow. If you increase interest rate, it slows down growth. If you do not increase rates, it increases inflation. Which is the better evil? So there's always a very tight rope with the central bank works on. And they have a comfort zone on inflation. The comfort zone, we have crossed the comfort zone on interest rate, on inflation in India. Comfort zone of RBI. So they have little choice but to increase interest rates. But I'm sure the approach of the Reserve Bank and knowing the stage of our development, they will not follow the Fed and increase it by 75 basis points every time. They will do cautionary increases. They will not destabilize the economy, and they will be much more prudent in balancing growth versus interest rate hike. Inflation, maybe inflation is there partly because of fuel, but if you hear some horrendous stories of what is happening in Europe and the US, you'll be shocked. What you pay €1 for petrol or electricity today is costing €4. It's gone up 300 to 400% because there's a shortage of energy. There's a shortage of water. There's a shortage of wheat. It's across Europe because Russia and Ukraine were providers of large amount of goods and services, being proximity to Europe. So on interest rate, I mentioned. On employment, I agree. Employment numbers are not going up. But you know, a problem India is having is not unemployment, but underemployment is our problem. People have jobs, but it's not adequate pay, not adequate enough to meet the needs of a family. And it's underemployed. Many people do now. This moonlighting is a big new word which has come up in the IT sector. And everyone is talking, we don't allow moonlighting. Now, who knew what moonlighting was a few months ago? Now, all IT companies are coming up saying, we will not allow moonlighting. How can they control? It's a little bit like the same thing, you know. I'm connected with a school in Bombay, one of the largest schools in Bombay. We tell the teachers, you cannot give private tuitions. But how can you control them? We know tuitions are going on privately after the school closes. We know parents send their children to extra classes, to tuition, but you can't control it. It's a little bit like that. So underemployment is our problem. And, you know, manufacturing, see the amount of jobs that are being created in the service sector. All the big companies like Tata's, Infosys, TCS, Infosys, Wipro, Capgemini, IBM, Accenture, they all hire something like 15 to 25,000 people per year. We are opening 2,000 new branches in 1 year, HDFC Bank. 2,000. You can imagine the number of people we'll be hiring for these 2,000 branches. So growth is happening, employment is happening. We should also improve the quality of education our colleges impart, because we find that people whom we employ, newly employed, they have to go through a massive training and skilling program. They're not employable on day one. We hire people because we need so many heads, but we have to train them. And attrition rates are very high in that low level. It is a little bit like a railway station. You come in and you'll see in IT systems also, when they talk of attrition, 20%, it's 20% per month. It is not 20% per annum. It's a similar thing in financial sector also, amongst the new sales team and that type of team. So I think employment with large manufacturing units coming up, I'm sure employment will happen. And today, I think it's a question of underemployment. Now, rural economy, we have to get rural people more income. How do we increase the income of rural people? You see that India will grow more if the rural community grows more. And if the food grain production increases, the rural economy does well and consumption increases. So hopefully with more food grain production, with more price increase, which government minimum price, support price, which they have increased recently, the farming community, the rural community will get more income to spend. But we have to continue concentrate on that. Rural roads, rural education, and how to increase the rural incomes, because they are a significant part of the society and they contribute a very small portion of our GDP. If you look at services, manufacturing, agriculture contributes only 15% of our GDP, but it has 60% of our workforce, directly and indirectly. So their contribution to the GDP has to come up if India has to grow. So we have to work to see how the 60% of our population who live in rural areas, who are in farming and other activities, allied with farming, whether it's logistics, transportation, or anything supplying, how do they function? How can they improve the GDP of the country? So that's on employment, that's on rural, and that's on interest rate. What is the fourth point? No, enough? Okay.
Thank you. Mr. Sen, yes. And after him, we'll take Mr. J.B. Pani from Odisha.
Good afternoon, sir. I'm Shavankar from a company.
I can't hear him.
Yes. Good afternoon, sir. I'm Shavankar Sen from Senco Gold Limited. We deal with gem and jewelry in retail. So, a question pertaining to gold, sir. We all know that as per the Basel III norms, gold is a security that is used by all the banks. Our country has tons and tons of gold that has been imported over the years. But unfortunately, the gold monetization scheme that the government has tried to initiate has not picked up so much. The banks, the various stakeholders related to gold has played a role. How do you think, sir, that the assets that are lying in the country can be utilized in a much more productive manner for the growth of the economy?
You know, this Dhanteras before Diwali, 20,000 crores of gold was sold in India. 19,200 is the number which the Gold Council has released. In one day, Dhanteras across India, 19,000 crores worth of gold was sold. Now, you and I may say it's dead investment because it's not generating more money, but still people are crazy about gold. How do we control our ladies, our wives at home, not to buy gold? We have to control them that it is better to buy a stock than buy gold. At least appreciate, where do you keep the gold? In bank lockers. So, you know, there are these specific companies that have been formed and they're reasonably successful, and foreign private equity people have also invested. The Muthoot Finance, Manappuram, where they specialize that you can keep your gold and you can borrow money against it. Although the rates are quite exorbitant, but they are very successful companies, Manappuram, Muthoot. So people are pledging their gold and borrowing money to make their home or car or whatever they want. So that is happening, but it's happening on a much smaller scale because people don't want to give gold away from the family and borrow. Only if you're desperate, you'll do that. But still, these two companies have survived. I had doubts whether they would do well, but they're doing well. And even foreigners feel that they have a good future because they invested in these companies, foreign private equity. So, but you know, gold is gold. It's an alternate form of currency. And it appreciates. Normally, it appreciates. In past some 1 decade or so, it did not appreciate. But it normally appreciates. So people take it as a measure of saving. People take it as a measure of investment. And I don't think what the government can do, you know, the government can't do anything. And because there's so much gold demand, the maximum people who smuggle gold into the country, every day in the newspaper, you see someone is caught on the border, someone is caught on the airports, smuggling gold in very, very different manners. You won't imagine, they put it in all kinds of places to bring gold into the country. I don't want to name it, but how they bring gold into the country, because the value of gold is here higher and the demand for gold is here. So, and the margin is very high, gold price here and gold price in the Middle East.
Sure. Yeah, Mr. Podar.
Harsh?
Thank you, Mr. Parekh, for striking such a positive and encouraging. Thank you, Mr. Parekh, for striking such a positive and encouraging note, both on the Indian economy and also lending and financial services. I had a question for you on what you think the structure of the financial institutions, the landscape is going to be going forward into the future. Because on the one side, we're saying the government is regulating large entities to make them, remain smaller. On the other side, we're discouraging smaller entities. And over the last couple of decades, there's been waves of people coming into banking and NBFCs and then consolidation. So I was wondering in the next 10, 20 years, do you expect India to have fewer lending institutions, but bigger ones, or a lot of, medium-sized institutions, each focusing on its own niche?
That's okay.
I wish I was your age, Harsh. I think the future in financial services is enormous because of low penetration levels of every financial product, as I mentioned. And I don't think the RBI or anyone is against NBFCs, provided you run your NBFCs prudently and properly and straightforward. There is an enormous possibility in NBFC. You have to get yourself registered, and their willingness of lenders, banks are willing to lend money to well-run NBFCs. How do you think how many NBFCs have come up? Where do they get the raw material which is financed from? From the banking sector, or they float bonds. Who buys the bonds? It's the banks and the insurance companies. It's not the public, it's institutional buying. So I think the future of small and medium level institutions are greater. I don't agree with you that more and more larger institutions will come up, but it's the smaller ones that will grow larger, the medium size will grow larger, and we need many more companies in the NBFCs to take care of the massive needs of the economy. And the biggest challenge, I don't think, is regulation. The biggest challenge is, where do you get your liabilities? Where do you get your funding from? That is a bigger challenge for NBFCs today than finding opportunities to lend. So don't be disheartened. You are in your early stages of your NBFC. You have a bright future ahead, and you are well qualified and educated to understand what is good and bad for an NBFC, and for the quite of credit you give.
Thank you.
Mr. Nagaraj Garla.
Sir, good afternoon, sir. This is Nagaraj Garla, actually.
He's joining from Bombay. He's joining from Bombay. Nagaraj Garla, IDBI. Yes, Mr. Garla, please go ahead.
Parekh ji, good afternoon. Actually, that was an excellent comprehensive note on Indian economy as well as a global economy. My question to you, sir, actually deposits are growing by 9%, advances are growing, our bank rate is growing by 18%. According to your view, actually, how a system is going to catch up, actually, or whether this will call for a further consolidation in the banking system, actually, whether actually, because a lot of innovations are happening around the retail credit, not much on the deposit side. So what is your view on the same?
When are you privatizing IDBI Bank? We've heard about this for 2 years, but there is no action. Do you have any idea? I have 2-3 people who are interested.
Oh, sir. Yes, sir. Sir, it is happening, actually. Department of Deepam has come out with a lot of details.
Expression of interest. Expression of interest. EOI.
Yes, yes.
No, you have a right question, that what can a country do if individuals are spending more money and the younger generation, India may be an ancient country, but with a young population. And you see how the younger generation spend money. We would never spend that kind of money which the youngsters are spending today. And they don't believe in savings. They don't believe in taking insurance policies. I have 43-year-old children. two boys, I tell them to take insurance policy for the children, either they don't want. They say, we are confident of our life. Why should we spend money and give it to an insurance company? We would rather spend and live well. So saving habit amongst youngsters is not there, and they are more confident about the future, their future, that they like to spend more money. And so we need more savers. How do you get more savers? There is a lot of cannibalization in the financial services. Where is the money going? The money is going to mutual funds. Where is the money going to insurance? Mutual funds and insurance, also their raw materials is cash, like banks and NBFC. So there are more and more insurance companies, so more people buy insurance policies, which is really depriving the banks to get the deposit. So the saving pool is limited. The issue we have is, how do we increase the saving pool? The demand for credit is there. How do we increase the savings pool? And you can increase the saving pool by offering more interest. You can offer higher interest than other banks. You'll get more deposits. But how do you lend then? How do you become viable then? How do you become profitable? So it's a $64 million question. If you increase your deposit rates, you'll get more deposits, but then you'll have to increase your lending rates. Then no one will come to you to borrow money at higher rates. So savings of the country has to improve, has to increase, and companies like LIC, but I'm talking EPFO, pension companies, they have large sums of money. And we should mobilize some of those savings. Those savings should come into industry. The pension schemes of the government, pension schemes of large companies, Employees Provident Fund Office. EPFO is one of the largest financial companies, but you don't hear about them because they've got a lot of savings. They put it in the banks only. So we have to, as a country, we have to increase our savings rate, our savings pool.
Mr. Goenka.
How much you want to go on? How long you want to go on?
Sir, just wanted your views and on the outlook and the impact of the exchange rate dollar rupee. But having heard your views on agriculture, since I chair the Agri Committee for Indian Chamber of Commerce, we find, sir, especially after the farm bills, given the fact that agriculture is a state subject, the entire policy making is in a significant state of limbo. And really the agri reforms and the kind of impact Indian agriculture can make on the economy is languishing. So what would be your prescription, sir, for this paralysis that we are going through, sir?
I thought the farm bill which the government introduced was the most advanced reform, which ultimately would have helped the farmers to get more revenue. But somehow they were wrongly advised. And you saw the number of days they were striking outside, went on strike outside Delhi and hunger strike and all. And you see, the biggest issue in Indian agriculture, according to me, is the intermediary cost. From the farm gate to the food plate, the inefficiencies are so many, and it's the intermediaries who make money. The farmer doesn't get the right deserved price, and the consumer is also paying a higher price. And the middlemen take the cake. And whether it is by logistics or food corporation trucks not coming on time and the perishable goods decaying, getting destroyed, lack of storage space for perishable goods. And so the whole system needs to improve. But I was also disappointed when the farm bill, which was forward-looking, got rejected. And government tried its best. They resisted for days and days, but they had to withdraw because of the obstinacy of our farmers. And they were not well informed, and they were probably influenced by the middlemen. Ki apne liye kharab hai, oppose kariye. So after that, I think the government, what else can the government do? They tried their best to introduce forward-looking bill, but and the sad part is that the middlemen are making more money today, and that still continues. And that's why food inflation is there. Food inflation, when you have surplus food grains, there should be no inflation in rice and wheat, but even we are facing inflation in food grains. See, the vegetable prices have gone up. Now, vegetable prices have gone up despite adequate production, because it's the market that squeezes, the middlemen that squeeze supply. It's exactly like OPEC countries reducing production and trying to increase prices. These middlemen also have a very strong hold on the farmers. And we have to break them, and the bill was going to break them, but that didn't happen, unfortunately.
Mr. Sanyal from Bandhan Bank.
Thank you. I'm Siddharth Sanyal, Chief Economist and Head of Research of Bandhan Bank. Two quick questions.
Keep the mic closer to you, please.
Could you hear me better, sir?
Yeah, that's better.
Sir, my name is Siddharth Sanyal. I'm Chief Economist and Head of Research of Bandhan Bank. Thank you very much for the fantastic and balanced view about India near term as well as long term. Sir, I have two quick questions for you, not directly related. One is, of late, over the last few months, we have heard a lot of discussions about the movement in exchange rate, and as if a weakening of rupee is a huge issue. While in case of the global economy, we have seen a lot of countries actually fight today for a lower exchange rate. So if you actually educate us a bit more about what is your view on that particular aspect, I think that can also be confidence boosting for us. And another issue, another question I would like to ask you, sir. While India has grown and prospered tremendously as a whole, as a country, one particular nagging question had always been there about income inequality and more so in case of wealth inequality. We seem to have, so in case if you, how exactly you see that particular issue? Are we actually in a position to improve on that particular aspect, or we have to live with that for a while? Thank you.
So on the exchange rate, it really depends on the regulator, and it very much depends on your present foreign exchange position. Are you an importer? Are you a bigger importer, or you're a bigger exporter? And how many months foreign exchange you need to have to be safe for your imports, to meet your imports. As I said, it's a very delicate balance, and the Monetary Policy Committee spends hours and days debating what should be the right exchange rate. Should we increase interest rate? They don't manipulate the exchange rate. It's a free market, but they intervene in the market sometimes when there's a free fall, whether it falls or when it significantly increases. So that's the role of the central bank, to avoid disruptions, significant disruptions, to have a cautious up or down exchange rate, and not something like a devaluation, which suddenly creates massive problems. So it's a very important role that Reserve Bank plays on maintaining balance of what is India's rupee equivalent to. And it's a very complex subject, and only free fall can hurt the country badly. And so always RBI is there to support and intervene in the market when there is a pressure on the currency, and not disrupting the macro level of growth. So it's very difficult to give you an answer. It's again, it depends if a country is, if China is exporting, they have a different attitude. They don't have we are a consumption-led economy, and China wants more exports. China was the export engine of the world, and so they have a different view, and they are not a democracy. They are a dictatorship. They can decide what exchange they want. In India and other democracies, it's a free exchange rate. If the market moves the exchange rate, only in exceptional cases does the Reserve Bank intervene to avoid a financial crisis, to avoid destabilization. I think that's what I can say about it. Second point is income and wealth. See, I think after a couple of years of static income levels because of COVID, many companies, including ours, 1 year had no increments to the staff because they were COVID. But this year, The increments are in double digits. Most companies I see, the salary and the wages have increased double digits, even the wages. 4-5% is something of the past. It's 9-10% increase in wages of factory workers. So incomes are going up. And the government also, if you see our taxation rate, every time that we have a budget, the amount of exemption the government gives for the low income people is increasing. So, and yet the collection, you see the revenue collection, the biggest news today is government revenues have gone up by over 30-35% this year, both direct taxes and indirect taxes, which is a great thing. Why do tax revenues go up? Because there's more income, because there's more compliance, because there's more jobs, because there's more profits. So income levels are growing up, and wealth, you don't have to ask me. You see every day someone is the third richest, fourth richest, first richest in Asia, and all these news come. And wealth of Indians is also growing. And I see large number of, in the next 10 years, you will at least see 100 to 200 family offices in India. Today, there may be 20 or 30, but I feel in the next 5-7 years, there'll be 100 family offices of Indian business houses. And where they will do private investment, they will do startups, support startups. So, the startup is a big industry in India. We have the second largest startup industry in India. We have number of icons, and not all will succeed, but some have succeeded. And some will fall by the wayside. Some will be, take for fintech. There's so many fintech startups in India. I don't know how they will survive. So many will survive. The banks and fintechs must work closely hand in hand rather than compete with each other. Fintech has some technological advantage which the bank has to take cognizance of. So a startup ecosystem is also being encouraged by the government. And there are a large number of foreign investors who support startups in India. I don't know whether I've answered your question on income and wealth, what you wanted to ask about income and wealth. Wealth is good if it's invested. Wealth is good if it's recycled. If it's investment, means it's recycled. Even if it's kept in the bank, it's recycled because banks will lend money then. So wealth doesn't remain uninvested. Wealth is always invested. No one keeps wealth in a bank locker.
I know, sir, people will be tempted to ask you more and more, but we understand we also have to respect the time. And especially you have been so kind to answer all the questions with great details. Now I request Mr. Beriwal for the vote of thanks.
Shri Deepak Parekh, Chairman, Housing Development and Financial Corporation, distinguished panelists and guests, ladies and gentlemen, good afternoon. I extend my sincere thanks to Shri Deepak Parekh for his gracious presence despite his extremely busy schedule and providing us with thought-provoking session on the financial sector and economy as a whole. I think the section could successfully address the key issues and scope associated at the present scenario with regards to financial sector. And moreover, the session has left behind with us a positive thought, positive sense in us for our country with growing economy in coming years. Thank you.
No.
So before we end, may I request President to kindly present a small token to our chief guest. So let the session end with a huge round of applause for such an interesting session.